So good morning, everyone, and welcome also to our online viewers. It is a great pleasure for me to introduce Philip Lane, who was a distinguished academic, first at Columbia, then at Trinity College Dublin, and then in 2015 became the governor of the Central Bank of Ireland, and in 2019 the chief economist of the European Central Bank. It is a particular pleasure for me because half of my CV is joined with Philip Lane, and so it's just a joy to see a friend I've been working with for the past 27 years, and also a particular pleasure for me given that today is my third birthday at Brookings, and so again, very happy to be with this institution. Without any further ado, Philip, the floor is yours. After that, we'll have a brief conversation and take some questions from the audience. Thank you.
Thank you, John Maria, and thanks to the Brookings Institution for hosting this event. So what I want to do today is go through the disinflation process in the euro area, see where we are now, and trying to explain to you, especially I suppose here with a US audience, about maybe some of the similarities and some of the differences between the dynamic of inflation in the euro area versus the US. So let me start with the kind of history of inflation from early 2019 onwards. And 2019, which is the first year when I was at the ECB, was, of course, a year that looked like a lot of other years before the pandemic, where inflation was very stable and, of course, substantially below the 2% target that we have. And at the very start of the pandemic in year one, there was a disinflationary momentum with the pandemic. In fact, inflation went slightly negative towards the end of 2020. But then we know what happened, especially from mid-21 onwards. But let me emphasize, the way I think about it is there were two sequential inflation shocks. One is mid-21 through the rest of 21, if you like, a pandemic recovery, inflation dynamic, which of course was over here as well. And then in February 22, the Ukraine war happened, and it's difficult to overstate the role in the European inflation dynamic of what happened between early 22 and around August 22, especially to gas prices. And the scale of this helped to bring inflation to north of 10% in late 22. And then what we've seen since then is this disinflation. By the way, in this chart, the kind of, I'm going to call them blue dots. The blue dots were what we taught in December 22. So in December 22, just in the shadow of that peak inflation rate, the assessment was, basically because of base effects, by the end of 23, inflation would be around 3%. And that largely was a kind of accurate enough forecast. In fact, the data came in a little bit faster than that. But broadly, the fact that there was a lot of disinflation in 23 was in line with what we thought at the end of 22. So that element has not been super surprising. And our projections, both ours and, I include in the chart other people, well, I mean, I think here actually it's mostly our projections, come down to 2%, in mid-25. So it's not over yet. The disinflation process is not over, and I'll explain later on what remains to be done. Let me also say you can see the role of energy and food by the big gap between headline and core inflation here. So core inflation picked up as well, but later. The peak of core inflation was more like July 23, not late 22. But also it's been visibly coming down in recent months. So we have both of these dynamics, and I'll come back to that quite a bit. So again, to break to look in more detail in what happened in 21, 22, 23, you can see in terms of what mattered, what drove the overall inflation, you had these really big red bars, the energy inflation rate, which was in the mid-40s at the peak. Energy is about 10% of the price index, so you go a long way just with the direct effect of energy. Because energy is a big indirect cost component for food and for elements of core. For example, energy, of course, is needed to run factories, to run the transportation services sector. Hotels, restaurants use a lot of energy. So there's just a kind of very pervasive energy effect. And what we saw last year is not only did that kind of level out, there's actually been a deflation in energy prices. And this is important. So the red bars there's been deflation in recent months. Food inflation, I mean, it's been an issue here, but it's a very big issue in Europe. Food inflation is about 20% of the index. And, a big contributor to the food inflation, as I said, was energy through different ways. And again, that hovered at quite a high level until fairly recently, but it's come down in the recent data. And then what you see also in terms of core is goods inflation. Usually goods inflation, like here, has been very low for a long time, but there was a surge of goods inflation, which obviously connects to the pandemic-related issue of bottlenecks. Global bottlenecks can help to explain the goods inflation. And then the remaining component, the light blue bars, are services inflation, which has come down, but not very much. And this is why the remaining inflation puzzle, if you like, is what will be the dynamic of services inflation in the coming months. So then that's what's happened so far. And then the right side of the chart, it says, well, what do we think is going to happen over the next year or two? And what you can see here is it's primarily about the core element, the green bar. But again, we don't separately forecast goods and services, but I think there's much less concern about goods inflation, which has a big global component and should not be so high. So it's really about services inflation. Okay, let me cut that data yet again. The point here is compared to the peak or to the start of last year, the disinflation is basically from the base effects and the fact, not only base effects, but the fact that energy prices actually fell, but also starting to be some contribution from lower core. Okay, so far I've retrospectively said the decline from peak inflation to where we were by the end of the year in the high twos is maybe not so mysterious. It's a reversal of the kind of upward impulse from the energy shock and from supply bottlenecks. Let me focus on the near term now, about compared to what we had in December, what is different now compared to when that forecast was made. So let me mention that the energy situation looks different to late November when the forecast was finalized. So on the left side for oil prices, the green line is what we had in the projection in terms of the dynamic of oil prices, and the orange line is the current situation. So basically this year it looks like oil prices would be lower than we had in our projection. This is very volatile, so by the time we have our March projection, who knows where we're going to be. But in terms of right now, that will reduce inflation pressure. But the more spectacular differential is with gas. So the green line is what we thought in the December projections. The orange line is what we see now, which is not only low, but expected to remain low. And given the centrality of gas to this whole inflation episode, this is something that we will have to think about. Okay, I'm now going to pause a little bit about, I've just thought a lot about projections. How confident are we in projections? So let me show you two variations about our look back about the forecast errors over the last few years. So what this shows you, and this is kind of 1 quarter ahead forecast errors, in late 21, through the first half, the first 9 months of 22, there were pretty big forecast errors. And of course, when your models are kind of not capturing the kind of inflation dynamic, then you're kind of how much policy relies on the forecast obviously becomes different. But in the last year, you can see in 2023, the forecast errors were very small. And in fact, most recently, they've been negative. This is a different cut of the data that says, well, where are those forecast errors coming from? The dominant issue when the big forecast errors were made was basically under-predicting energy prices. But of course, I think everyone knows it's really difficult in an unstable situation to have a good handle on the energy inflation dynamic. There is an element of trying to work out how to capture inflation persistence, how intrinsic persistence in inflation, how sticky is inflation. There's been a back and forth on that, and it's played a role to some extent, and that's an ongoing issue. Okay, so in terms of the inflation dynamic, this is obviously very different to before the pandemic. So let me rely on basically what I'm going to do next is I'm going to integrate some work we've done at the ECB with some work at the BIS, which I think is helpful for locating the current episode in a historical context. So what the BIS has done is they went back and let's look at lots of episodes of surges in inflation. And what does today's episode look like? So here I'm just going to compare the EU area to that historical data set. You could also, of course, do it for the US and for other countries. And what you see is, so this 0 is the peak inflation rate. You say, okay, in the 2 years before, and what happens afterwards? What does inflation look like? So for headline inflation, you see this episode was a much sharper jump in inflation. This is a really big movement from basically 1% inflation to 10% inflation. Whereas what happened typically historically is an inflation surge was going from mid-level inflation to high inflation, not from zero inflation to high inflation. And what's interesting is that disinflation in headline has been faster. At this point, it's been faster than the historical experience. So fast up, fast down, if you like, in terms of headline. When you look at core inflation on the right, it's a bit different. The core inflation, there's a rapid run-up, but core has not fallen so much compared to that historical episode. And I think, again, this connects to the spillovers from energy to core and lags in wage adjustment and so on. But this helps to explain why, even though headline has come down a lot, there are still, you can't rely on the historical evidence to say we know for sure what the dynamic of core inflation is going to be. Of course, core has two components which are not that connected, goods inflation and services inflation. So if you look at that, in fact, goods disinflation has been faster than normal. So there's not a kind of stickiness in goods inflation to be concerned about. This makes sense. If supply bottlenecks created the goods inflation, the easing of supply bottlenecks helps explain why goods inflation can come down quickly. But services inflation is, again, it's above the historical distribution. And again, this is why we remain data dependent in thinking about services inflation. Okay, so that's kind of a little bit of historical context. So again, let me come back to the near term, about 2024. So what I show here is the kind of orange diamonds is what's in our forecast. That inflation, headline inflation, would basically hover in the high twos this year. And core inflation would improve, but again, mid-high twos this year. So compared to that, which is now a while ago when we made the December projection, what is the latest thinking? So here, on the left, the green line is consensus. So this is the survey of other people, not us. The survey of other people has inflation coming in lower this year than in our December projection. And what I also show here is this machine learning model at the ECB. So now the research team who developed this put this out at the end of last year, but it's part of what we look at now. And the central tendency in that machine learning model, it also thinks inflation will come in lower. but I also show you the range of possibilities because they spit out a big range. And given the range of possibilities, again, it supports the data dependence conjecture. At the right side, we don't have consensus for core, but this machine learning technique does say there may be faster progress in core inflation as well. What I would say is that this is focused on the near term. It does not necessarily read across to the medium term. So, for example, falling energy prices will lower inflation in the near term, but falling energy prices raise real incomes. It's a terms of trade gain for Europe, which can have opposing effects in 25, 26. In the same way, when energy prices were going up, I and others would say, look, in the near term it's inflationary. In the medium term, there's real income effects which can move in the other direction. So, in terms of working out the medium term, of course, the staff are working on the March projections. But in our monetary policy meeting in January, we basically said, look, right now we don't have any immediate change of outlook about the medium term, because working through the implications of oil prices, energy prices, and changing financial conditions for the medium term is a more complicated situation. So this is just about the near term. We've said for over a year that we want to see our kind of assessment validated in the dynamics of underlying inflation. Underlying inflation is basically the component of inflation that is projected to remain for another year. So it's the 12 months ahead forecast. You might say, okay, let's take out the volatile oil and energy and food components, and is it not about core inflation? Or let's look at other adjusted measures, and there's a whole range at the ECB. So let me emphasize here, it's important to take a nuanced approach to interpreting these measures, because these measures were largely developed under more normal conditions. They were not developed under conditions with supply bottlenecks. They were not developed under conditions of 10 standard deviation movements in energy prices. And so these measures, because the scale of the energy price increase meant everyone was raising prices in mid-late 22. It looked like because services prices were going up, goods prices were going up, and historically those inflation rates were persistent. The unadjusted measures were sending signals that were quite high a year ago, but they've come way down. So then the question is, in what sense are these underlying inflation measures if they move down so quickly? They don't seem to be very good forecasters of 1 year ahead inflation. So at the ECB, we've made adjusted measures, which says, let's take out the supply bottlenecks. Let's take out the indirect effect of energy. And so these adjusted measures in the middle panel basically say, they never went up that much, because once you allow for the fact to be a reversal in the impact of energy and supply bottlenecks, the underlying increase was a lot lower. But by the same token, let's not exaggerate the progress in recent months. If the progress in recent months is coming from the easing of supply bottlenecks and lower energy prices, that's a windfall. It doesn't necessarily tell you that the underlying inflation momentum has weakened to the same amount as in the unadjusted measures. A popular sport is to look at momentum. So here I look at 3-month and 3-month, seasonally adjusted. And what is absolutely true is by the end of last year, momentum in overall inflation was below 2%. Because energy inflation, because this is a dual scale, energy inflation is on the right scale, which is deeply negative in terms of momentum for chunks of last year. And food inflation has also come down. So we do have low momentum in overall inflation. And in terms of core, momentum in goods inflation now is very close to 0, and momentum in services is around 2. So on that basis, some people say, well, is this not a challenge to your medium-term forecast? But basically, and in the written text for the speech I go into in more detail, what we have here is essentially there were one-offs in 2023 which are not going to lead to further disinflation this year. We're not going to have massive deflation in energy prices. We may have some, but not massive. We're not going to have, once bottlenecks have been relaxed, you can't further relax the bottlenecks. Also in Europe, and maybe a bit different to here in America, demand was very weak last year. Consumption was very weak. Restrictive monetary policy played a role. And so the conditions to raise prices were weak last year. This year, the December projection has a good increase in the growth rate of the European economy, has a significant increase in consumption, and that will increase pricing power of firms. So less of a base effect from energy, a stronger demand environment, and with the bottlenecks disappearing, last year essentially falling non-labour input costs compensated for rising labour input costs. So the overall cost pressure in firms was muted. This year, rising labour costs are going to be there. We don't have, we think, falling intermediate prices, and therefore the wage costs to some extent may pass into further price increases. That's fully allowed for in our projection. So the projection to get to 2% next year does allow for all of that. So this momentum, in other words, we think momentum will pick up, but not in a way that threatens the 2% forecast for next year. So again, it's important to put momentum into context. Okay, this is now the famous wage issue, because I've said services inflation is what remains a concern. Some parts of services inflation did come down last year because of the fact the pandemic reopening phase has weakened. There's a lot of price increases in tourist-related activities, entertainment-related activities from like mid-22 to late 23, if you like. So part of services disinflation, so we've had services disinflation in some sectors, but in the wage-intensive sectors, it looks like there's still price pressures. Okay, so let me go through the wage indicators, because I mean the bottom line here is there are early signs of deceleration, but it's still early stages. So in terms of looking to see more deceleration of wages, that is going to be important. So let me walk you through it here. So the blue line is compensation per employee from the national accounts. That takes into account all of the different labour costs that you might have. And what you can see here, if you stare hard enough, is there's a mild deceleration from Q2 23 to Q3 23. But that's all we have. We don't have Q4 yet, let alone Q1. The light blue line is unit labour costs. Unit labour costs were climbing to north of 6% last year, because unlike here, labour productivity growth has been negative. So firms have not been able to absorb rising wages with rising productivity, which is normally you'd at least partially rely on that. Another way of saying that is the weak economy last year meant firms had a big payroll bill, but they didn't have the revenues to match that. And that increases unit costs. So again, in our forecast, we project that the recovery in GDP this year will allow firms to produce more without necessarily having to increase their labour input. And so unit labour costs improve more quickly this year, even with wages only slightly decelerating. And then when you think about compensation per employee, there's two parts of your paycheck. One is what your wage contract says, and then what's called a wage drift. Things like overtime, getting promotions, and so on. That tends to happen in a hot economy, less so in a weaker economy. And the dotted green line says, look, we've seen that over the course of last year. As the economy weakened, those extra elements, the wage drift, have come down. So this is why the focus is on negotiated wages, because that's we think is going to be the main driver of overall labour costs. And these, are the red line here. We've yet to see a turnaround in the aggregate data. And this is why your system, we've developed what's called a wage tracker. So the main central banks are keeping an eye on basically any significant wage settlement in any given sector in those countries. And then that's aggregated up So we weight what we see in the kind of chemical workers in Germany with whatever, the transport workers in France, to get an overall sense. And we think it should be a good leading indicator what the latest agreements are signing for. And what we see here on the left is at the end of last year, there's some deceleration compared to Q3. But we need to see more. We need to see more deceleration. And there's going to be a lot of wage settlements January, February, March this year. So this is why we say we're waiting to see what the wage data look like. And again, it's not that our central belief is there will be deceleration, and that's shared by the surveys we do. So what this is a range of surveys, other economists and the survey professional forecasters. We ask the big corporates that we talk to in the quaintly named corporate telephone survey. I'm not so sure we phone them up all the time these days. There might be other communication. But they all have a consistent narrative similar to ours, which is deceleration this year, more deceleration next year, and maybe something more back to normal around 3% annual in 26. So we need to see. So this is again, all the indications are we should see it, but we actually need to see some of it in the hard data. Then you might say, well, how can firms, because this is still above steady state rates of wage increases, is this not going to create extra inflation? So again, the conjecture we have is that firms will absorb part of rising labour costs in lower profits. And one thing that we were able to do recently is, because of course the actual corporate annual accounts come in slowly, but we now, through Orbis, have 2022 annual accounts, which confirm from a bottom-up estimate that profits did rise quite a bit in 21-22. So in other words, the profit compression that we're expecting is compressing profits from an unusually high number back towards normal. And therefore, we don't think it's going to overly constrain investment behaviour and so on. And then again, in the corporate telephone survey, it's consistent with this idea that there is a profit compression going on. So let me make a couple more points and to just finish. One is on, we have a different issue to the US about long-run inflation expectations. Because, of course, before this happened, we had a problem of de-anchoring to below 2%. And what's happened with the inflation surge is basically more and more people now believe we're going to deliver 2%. They don't think we're going back to inflation around 1.5. So this is a re-anchoring at the target. There's been some tail, people in the tail who think we'll remain above target. But that scenario has also come in. So if you think about the risk premium, the 5-year inflation swaps, the risk-adjusted measure has been solid around 2, but the risk premium is coming in. So even those people who are concerned that inflation might hover above 2, there's less of that is valued. So there's an increasing confidence that the 2% medium target will be delivered. So let me stop there, and maybe I'll just conclude with what's not going to be a surprising monetary policy conclusion from this, which is the baseline is getting back to 2% inflation next year. What we're seeing is broadly in line with that baseline. But in order to have any further thinking about the policy position, moving away from the hold position we've been in since last September, we need just to have greater confidence in this baseline. And that's why we're waiting for the incoming data on everything, of course, because we need to see the recovery in the economy. We also need to see wages decelerate, and we need to see prices absorbing some of the increasing labour cost. So with that, let me hand back to John Maria, but I guess we're going to have a conversation. So, thank you.
Okay, well, Philip, thanks a lot. Illuminating, very comprehensive. I'm just going to follow up on a couple of themes. One is relates to counterfactuals. I think it's very nice, especially in your written speech, you emphasize a lot the role of uncertainty and how the perception of inflation risks really changed dramatically between, say, the mid-2021 and subsequent quarters. So I wanted to ask you, what is your sense of the relevance of the timing of tightening in explaining inflation dynamics, or to put it more basically, what would have been the consequences in your view, with the benefit of hindsight, of raising interest rates, starting the process of monetary policy normalization, of raising interest rates a bit earlier?
So this debate is going to be with us for a long time. There's going to be, already there's a industry, there's going to be a bigger industry going back and looking at this. So I do think it's very important for us and for, of course, outside voices to look back. And I'll just connect to a bit of what I said here and be specific about the ECB situation. So what I said, and I think it's very relevant for the ECB, is basically there were two inflation shocks. One is what happened in 21, but then it was overtaken in February 22 by the second inflation shock, which was the Ukraine war. So there are two counterfactuals. One is what should have been the response to the first inflation shock, the one that was already being discussed in 21. And then second, what should have been the response to the second inflation shock, which is really in March 22, February, March 22. Okay, so that's a framing that there's basically two inflation shocks to deal with, not one. Second, what we had in late 2021, we were still doing a lot of QE. So the question is, how do you move, and also the markets expected QE to remain. They expected, if you look at their views in late 21, expected QE to remain at a high volume, expected rates not to go up very much. So how do you go from that situation? So even, let's say we had perfect foresight, okay, let's say we need to move. How do you move step by step to get out of that? So what I would say is maybe an interesting area for inquiry is we had a sequence, as did the Fed, that we should stop QE before we start raising rates. There's a kind of very solid logic to it, but I think that is worth looking at. So I'm sure there'll be many people worth looking at that sequencing issue. Then what I would say, which I think was hinted in the way you framed the question, is those who have run counterfactuals are fairly clear that essentially what matters for dampening demand, restricting the role of monetary policy and restricting pricing pressure is basically, if you like, the average interest rate over a number of quarters. So if you moved a little bit earlier, but didn't move that much, and again, whether that would have much of a difference to essentially what we did do is we did wait. But once we had concluded that we had work to do, we did a lot. And so the overall contribution of monetary policy, I think it's, and especially, look, we've seen it. We've seen inflation come down a lot over the last year. So running the counterfactual, I would let other people do that. I mean, we should be graded. So A+, A, so I'm not going to self-grade. So it's not just pass-fail, I think. But there's a grading here, and I think that will keep people busy. I may have forgotten the second part of your question.
No, I think that's great. And maybe I'll follow up a bit on this. broadly the same theme. How do you think about the impact of monetary policy on aggregate demand and through that, on containing inflation in Europe? So presumably you look at sectoral developments where you have more interest-sensitive sectors. How does that square with, the post-COVID sectoral dynamics, which had their own momentum?
Yes, so I think this is very important for us, because what we said throughout is in thinking about the right level of interest rates, we have to assess the strength of monetary transmission. And then what are the channels of monetary transmission? One is to financing conditions. Second, from financing conditions to, as you say, demand. Then there's also true inflation expectations. So this is such a dramatic episode in terms of the surge in inflation. And to repeat, by and large, people did not believe that this was going to last forever. Medium-term expectations remained fairly stable. And in fact, for the euro area, they came up from below target towards target. But what was open to question, and this is where monetary policy is important, and this has been embedded in our phrasing throughout, is to make sure inflation comes back to 2% in a timely manner. So in other words, if you like, with the base effects, repair of supply bottlenecks, you could argue over time, eventually inflation would get back to 2%. But the risk factor was if we had not accelerated that return to 2%. And I think that's essentially what monetary policy has been doing, is accelerating the return. It would not have been, it would have been, I think, perfectly plausible that price setters, wage setters would say, well, not only do we have to look for compensation for the inflation surge, we also have to look for compensation that they're going to allow several years of materially above target inflation. So we did really want to get back to target in a timely manner, if you like, to control the 1 year ahead inflation expectations. And that is very important. And this is where, for us, we've seen it. So let me explain how we kind of go about looking at it. I think everywhere it's pretty obvious that the most interest rate sensitive sectors would be hit first. So in early 22, when the forward curve started to move, so 6 months before we raised rates, construction already just stopped because the yield curve moved so much, the construction sector already started to adjust. So that's very interest rate sensitive. I think we see it, there's a clear durables move more quickly than services. But let me emphasize, within services, we've done work at ECB, which I think makes sense, which is, if you like, discretionary items get hit more than essentials. And there's a lot of discretionary services. So if you're kind of facing tighter financing conditions as a consumer, the hierarchy of how you adjust, we see it in the data. So I think there is a kind of a distribution across sectors. So, I think we are saying it on a regular basis in the monetary policy statement. Monetary policy is transmitting powerfully. We see it in financing conditions. We see it in the fact that credit dynamics moved very quickly towards nominal credit not growing very much for the last year. And we see it in last year, consumption was relatively weak, investment was relatively weak. So if you like, there's a lot of evidence in the European context that monetary policy has been doing a lot here to accelerate the return to 2%.
Thank you. In the last part of your speech, you focused on real wages and wage dynamics and profit margins. I wanted maybe to touch on that a little bit more in detail. So clearly, real wages took a huge hit, deflated by the consumer price index during 2022 and the first part of 2023. I see that you're trying to distinguish between the one-offs, which presumably
also compensation for past real wage losses and sort of the intrinsic momentum in wages. Is it through your reading of wage contracts, whether you have one-offs, and more generally, how do you see that playing out going forward? Because presumably now, with inflation back at levels actually not far from target, the normal component of wage dynamics should go back to more consistent levels.
Yeah, so let me say over the last year or so, I think the wage dynamic has been basically in line with what the staff had predicted. So we've not really been surprised by the wage dynamic. But what is true is because of multi-year contracts in Europe, the adjustment to the surprise inflation is playing out over several years. And there is as I say, the typical wage contract has a catch-up component. So essentially the wage bargaining normally would be forward-looking, saying what do you expect inflation to be in the next year, what do you expect, how the firm is going to do, what the economy is going to do. So it should be a forward-looking element. That is there, and a forward-looking, I think everyone believes inflation is going to be relatively low. So there isn't a kind of impulse from the forward component. But it remains the case there's a kind of a range of possibilities about how quickly the drop in real wages will be corrected. And it varies across countries, because across Europe we have different labour market institutions. The labour market has different levels of tightness across different countries. So I think it's important. So let me say the reason why I show with and without one-offs, it's really important to include the one-offs. It's not that the one-offs, I mean, I don't think there's going to be a lot of one-offs in the coming negotiations. But what is true is because the price level effect is basically permanent. Any one-off payment from a year or two ago is now being folded into the official wage. And this is why you need to look at the aggregate, because the official wage might jump quite a bit this year, but total compensation will grow much more slowly because the one-off is disappearing from the data. So it's very important to have a consistent series, because because you can see in some scenarios, if you look at kind of the regular wage, you might see a big jump this year, but it's misleading because the one-off is disappearing. So the total labour cost to the firm, could be decelerating even with a pickup in that component. So I think we're doing the year system is really on it. They're really tracking a lot of different indicators. And so we do have a lot of information coming in. And again, to repeat, it's about building confidence in our baseline. There's nothing so far to indicate that there's anything wildly different to what we have in our baseline.
Okay. Mindful of not crowding out questions from the audience, but let me maybe ask you two more questions. I'll try to combine them. One is there has been a debate in the US on the extent to which the last mile of the disinflation could be a bit harder because you have, you've had fundamentally so far been helped by the factors that hurt inflation in the raised inflation during the previous periods. You had an unwinding bottlenecks, you have lower energy prices, and all these things are dropping out. Is your sense that indeed you may have a more difficult road ahead, also in explaining to the public why monetary policy stays relatively tight? Or is your sense that we have basically the momentum is clearly pointing in the right direction and that we're heading towards the 2% target with reasonable confidence? And combining the second part is, where do you think we're going to eventually end up? once we go beyond the next couple of years. Again, whole debate on neutral level of interest rates and whether we can go back to situations where inflation is actually too low.
So let me break this down into different elements. So what I would say is for the EU area, that the risks around the 2% target are two-sided. It really is the case that we do have a kind of a plausible and I think economically meaningful upside risk in this wage issue. So we remain, because wages is just such a big part of the overall cost in the economy. Yeah. And given that there is a real wage gap, there's a range of arguable dynamics for wages. So we need to let the data speak a little bit about where we're going to land on that. So in terms of when our staff do simulations about what might keep you away from the 2% target, the scenario where you get a kind of a self-reinforcing loop where wages don't decelerate so much, firms have to add to their prices, which in turn triggers more wage. Yeah. So having a kind of a wage dynamic, which is not massively away, but sufficiently away from where it needs to be. So that is a genuine, I think, material upside risk that we need to see diminish. But the volatility in energy, look at the volatility in energy that I showed you, the volatility in goods inflation, and what I said was basically momentum at the end of last year was relatively low, but we think it's going to pick up. So that means that I think there is a two-sided risk, and this is where we will have to navigate that two-sided risk. I'm going to outsource the question about where we might be in the future. So let me say, and we published yesterday or the day before, you can find the ECB website, there's a kind of article by a team of researchers looking at different models of R-star. So we've put out now this, where they differentiate between some cyclical models versus, if you like, the steady state. And the steady state, there is a range, of course, but it is clustered around 0. It's not too far from 0. And then when you add in the inflation target, you can see which, in a hypothetical steady state, that's kind of what people might, and that's in our survey of monetary analysts as well. But let me emphasize is, that says if there's no shocks in the world, that's where you're going to be. So are we going to be in a situation in the next couple of years where basically nothing happens? Nothing happens and we just kind of convert. So conceptually, it's an interesting debate. But it really is the case. And then when you go local about where exactly is it, and you talk about plus or minus 25 or 50 basis points, that's when you're going to see it. You'll know when you see it. You're not going to be able to pinpoint that with historical evidence. So let me, if I want to think more broadly, I think it's a fair comment, given all we're seeing in the world. It's a big decade in terms of the climate transition, geopolitics, digitalization, AI. My sense is that may create more volatility. Volatility is different to trend inflation, but monetary policy, I think, has to respond to some of that. If it's kind of 1 month of volatility, you can ignore it. But I think what we've seen from this episode is you can have a volatility stretching over a relevant horizon for monetary policy of a year or two. So monetary policy, we may be busy.
Well, thank you very much, Philip. And let me take some questions from the audience. I see Angel's hand there.
Angel Ubide from Citadel. Thank you, Philip, and I would give you an A at least. So congratulations on a great job. Let me just follow up on the question on the last mile, right? Shouldn't the last mile be symmetric? You showed in your last slides that inflation expectations are finally anchored at around 2%, but they were anchored a little bit below 2% in the period prior to the pandemic, right? So when thinking about the last mile now coming from above, shouldn't the last mile, in some sense, try to stabilize inflation in the 2 to 2.5% range, rather than precisely at 2, given that we know that the last mile to come back from below is also quite tough, and at least that's what the experience of the last 20 years has been? Or has anything changed in the last 2 or 3 years that would change this sort of symmetric approach to the target? Thank you.
Okay, the way I'm going to organize my response to you is what it tells me, and which has been very important in this whole episode, is really have this laser focus on inflation expectations, which is a two-sided issue. Because clearly we were very concerned when we saw indications. Again, not that the 5-year ahead was drifting away from 2%, but that people were starting to get pessimistic that it would take a long time for inflation to get close enough to the target that you know. So I would say that's a two-sided issue, especially given the history of the euro area. So I would say that this elevates the attention we have on, and let me emphasize at the ECB now. Is before the pandemic, is just I think good practice by the ECB. We developed this consumer expectation survey, which has been very helpful. We now have monthly data on consumer expectations, and we're also developing firm level expectations data. So that's very important as well, to have a good understanding of how firms think about not just their own pricing decisions, but the inflation environment in which they work. So there's a very natural reason why people should believe that the inflation should converge to where we want it to converge, but we very much have to be vigilant on a two-sided basis about that.
Thank you, Philip. And Peter. Yes.
Bloomberg Turkey office. Philip, I have a question about the ECB's actually interest rates. So when do you expect the ECB to begin cutting interest rates? And the second question is it's very an important question actually for us. So Turkey started to increase interest rates very late when you compare to the other countries. So its easing process will be also late, we expect. So how do you think this affect the inflation?
Okay.
Thank you so much.
Thank you for the question. I'm not going to try and work out the monetary policy for Turkey, which is so I won't answer that question. On the first question in the written speech, basically what I say is what we have to do is balance the fact that obviously if we move away from this holding position where we are too early, it's problematic. But equally, on a two-sided basis, we don't want to go to a situation where we are materially below target, because the consequences of de-anchoring to below, the consequences of returning closer to lower band are unattractive. So what I will say is we'll do it at the right time. So we'll do it at the right time. And what we basically, in January, as President Lagarde said at the press conference, I mean, there's a strong consensus at the time of the January meeting. It was too early to start thinking about it. We really need to let the data come in for a while. I mean, to repeat, the forecast errors have been low. The narrative behind the baseline, I think, is a sensible narrative. But it's important in this world of high uncertainty. I mean, the machine learning model that I showed you is very helpful. It combines 60 variables in different combinations and kind of does probability weighted averaging and so on. And what it shows you is just, look, there's a wide range of possibilities here. You will have data surprises. And so allowing a bit of time to let the data come in will be important. Because there are, there's a range of possibilities. We don't want to put all of our bets on the baseline, because there is a range, and I think we do have some time at this point to wait on the incoming data.
Peter.
So I want to echo the view that I think you get a very high grade. I'm very glad you're in charge and not your critics, particularly on this side of the Atlantic. The problem now, analytical issue you've got now, you emphasizes services and wages. But maybe one of the reasons why that's particularly difficult to pin down is that you're analyzing them in terms of inflation of services rather than relative prices of services. The issue being that there is an adjustment from disequilibrium going on. If you were to do it, the analysis in terms of relative services prices, you would have a view as to where the adjustment of services prices would have corrected the disequilibrium and stop. Essentially, you could do exactly the same thing for wages. You could say, what is the right level of nominal wage increase which would correct for the permanent price increase that we target, and measure your assessment of whether or not you're on track or off track relative to both of those things.
Yeah, so I fully agree with that perspective, and we try and do that kind of exercise. And again, in late 22, I wrote a ECB blog post about trying to diagnose inflation, where I put a lot of emphasis on there's a lot of relative price movements going on here. So let me come back to this question, because let's say at some destination point X, there's a full adjustment to the surprise increase in the price level that happened more quickly than wages responded. First of all, that destination X, you have to think about how much the fact that Europe has had this terms of trade loss, does that affect the equilibrium real wage? In other words, is full compensation the focal point, or is there some other? So that's one. But from our point of view for inflation, what's very important is the speed to that adjustment is really important. Essentially, if it goes too quickly, then you get this kind of risk that you would have a further bout of high price increases because wages are going up so quickly. And then if you have that, and then if you have people who are forming the inflation expectations in part on the basis of what they see, that having a kind of intense period of catch-up would be good for consumption, of course, in the near term. But typically the simulations have that, but then they have inflation remaining higher for longer, and Europe is an open economy, a risk of competitiveness losses, because if real wages go up too quickly, you have that risk, especially in the context of the competitiveness loss of the high energy prices in Europe. So the simulations basically say a multi-year adjustment is basically trades off bringing inflation down back towards target, restoring real wages to the equilibrium, but in a kind of phased basis. So we don't control the labour market. We don't control what's going into the wage negotiations. But analytically, if wages did not grow enough, we wouldn't. So this year we have the recovery in the European economy that we project is heavily based on wages rising enough that people can start to increase their consumption. So our forecast needs significant wage increases, but it's a balancing act. They have to be significant, but not so high that they derail the disinflation process. So there's a kind of a pathway here. There's a balancing act here. And so far, I think everyone, let me emphasize again, everyone in Europe, the union leaders, the employers, no one wants a repeat of 1970s. So I think there's been a very, by and large, lots of exceptions, but by and large, the kind of wage adjustment process has been, I think, striking that balance. But we just need to see that continue.
On this note, I think we've reached the end of our conversation. Please join me in thanking Philip for a fascinating presentation and discussion.